All right, everyone, JJ here. Wanted to give a stimulus check and bill update as well as a stock market update. So first, a couple excerpts from House Speaker Nancy Pelosi. She says that Democrats in the White House are just about there on a coronavirus stimulus deal. However, she did caution that it could take a while for Congress to write and actually approve a bill. So some cautious optimism from Nancy Pelosi. On the other side of the table, I'm just going to read a tweet here real quick. Donald Trump said, "Just don't see any way Nancy Pelosi and crying Chuck Schumer will be willing to do what is right for our great American workers or our wonderful USA itself on stimulus. Their primary focus is bailing out poorly run and high crime Democrat cities and states." So I'm going to go ahead and let you, the audience, figure out how you want to decipher that message. But there's definitely some politics still going on when it gets to how quickly the phrasing and the negotiations that are going on between the Republicans and the Democrats, they're closer, but we're unlikely to have that stimulus approved in the near term. But keep following along and we'll see if there's more progress made and what the new timetable looks like for actual writing, voting, approval, and getting much needed stimulus out to the American people. All right, next update here. So let's talk a little bit about the stock market. The market has had a lot of volatility this year. If we remember going back to March of 2020, we had the first initial wave of coronavirus shutdowns, and the markets went from their peaks down about 34%. Over the last few months, we've recovered everything. As long as you didn't sell in March, you're actually slightly positive on most equity portfolios this year. Now, that comes from a big dichotomy between growth and value. Technology stocks have largely done very well during the shutdown. They've been resilient and have actually fared better because of the shutdowns. Companies like DocuSign, Netflix, Facebook, Google, they may be trading at near all-time highs, record earnings reports, a lot of money flowing into that sector. On the flip side, when we think about the value stocks, which would be larger, more established companies, generally that pay dividends, as well as the retail sector, which would fall generally in the value category, as well as the travel and leisure sector, casinos, and gaming. So let's kind of break that apart a little bit. The casinos and gaming sector has really been hit hard. Las Vegas was closed most places up until very recently. They've had to put in major restrictions, a lot less people packing tables these days. And due to that, the casino and gaming stocks have not done as well. Most of them, if we think of, let's say something like a Wynn or a Caesars, they're trading likely at half or even less than that from their highs. When I looked at Wynn today, it's at about $75 a share, as high as over $200 a share or so about a year ago. We'll put a chart up to look over that one. When we also think about some of the other travel and leisure holdings, American Airlines, one of the more indebted airlines that's been out there, it's tough sailing. And that's a sector where I don't see a clear path forward. There's going to be a lot of volatility. They're going to need a lot more money to survive, keep their employees, as well as really stay profitable as a business. No surprise, airlines are very difficult to operate and a lot of regulatory burden. Now, where there is some pockets of potential opportunity is in companies like Class A REITs. The name that would come to mind is a Simon Property Group, ticker symbol SPG. This is a company that was trading at over $180 a share. We had COVID that came in, and their business was really decimated for a number of months because they have revenue collection that comes from just straight rent, but a lot of times they'll also have a revenue split with the tenant that they have in there. For instance, let's say XYZ restaurant pays $5,000 a month. They will also have a portion tied to their revenue, let's say $500,000 for easy math. Anything above $500,000 might be an additional split that goes to Simon Property Group. So in that structure and that kind of format, this is something that really hasn't seen as much of the incentive upside for Simon Property Group. But on a go-forward basis, we're starting to see some stabilization. Depending upon where you live in the country, if it's Florida, you probably have pretty much open restrictions now at this point. If you live in Chicagoland or Illinois like we do, a lot more hesitant, still major restrictions. But if we look at the country and companies in aggregate, we're starting to see a lot more loosening. More people are actually starting to go to malls. The expectation is that at some point in 2021, things are going to get to some semblance of near normal. And recoveries are likely to be in somewhat of a full swing. And part of this recovery, I'll switch from Simon Property Group and talk a little bit more about a company like Nordstrom, which would actually be a tenant in a lot of Simon Properties malls. Nordstrom is a company that has a large brick and mortar presence. I like them for a number of reasons, however, even though that brick and mortar business model is a tough one to operate. They've got a lot less competition. JCPenney's of the world, Sears of the world, those big box stores, most of them aren't operating. Lord & Taylor went bankrupt, so they're just liquidating their inventory. So Nordstrom has less supply of competitors. They have high insider ownership. The Nordstrom family still owns over 30% of the outstanding stock float. So you have a well-capitalized, invested family that doesn't want to see their hard work go to zero. And then now you've got a company that's traded at a market cap of under $3 billion, probably even closer to $2 billion. They're at about $13 or so a share, about $13.50. They had a nice uptick today. But a company like this, if we actually start to see cyclicality in the consumer sector come back, people are going to spend some money over the Christmas season. There are people that are unemployed, but there's also people that are still doing relatively well, especially in the higher income brackets. The general customer for a Nordstrom is going to be someone or a household that makes over $100,000. And in this kind of environment, that household has been less affected. So I think Nordstrom is definitely a name to watch, a place for potential value, whereas the tech side of the market has gotten a lot more expensive for good reason. Multiples are high there. Earnings expectations are high. They could continue to do well, but there's a lot more risk in that sector. Versus a Nordstrom is trading at near rock bottom prices. And there's definitely some asymmetric upside if you're looking and considering a 2020 recovery, consumer spending, unemployment, as well as potential passing of stimulus and the tailwind of vaccines from a number of these phase 3 trials. So we'll talk more about that at a later time. But I think that this is definitely a place to start picking winners. Really start to look for companies that you believe in, that you think are going to be here for the next 10 years and are going to be not just survivors, but thrivers in the new normal. Thanks so much for tuning in. Don't forget to like this video and subscribe to my channel.